You're probably looking at a defined benefit plan, or you have a defined benefit plan. You're looking for ways to save a bunch of money for retirement and also probably to lower your taxes. Well, you're watching the right video. My name is Kenner French with vastsolutionsgroup.com. We do business all over the country. We've been in business since 1969, and one of our specialties, qualified plans, of which defined benefit plans fall into that category. Let's get right into a presentation. We're going to go over real quickly ways to help you as a plan sponsor to make sure that you're running your qualified plan, your defined benefit plan correctly. And also, who knows, maybe we're going to pick up some ideas about how to, who knows, get a little bit smarter about qualified plans or defined benefit plans. So, I've dubbed it Mastering Defined Benefit Plans, a guide for plan sponsor. It's a quick guide. And once again, I'm with vastsolutionsgroup.com. So let's quick introduction. You might have put together a defined benefit plan and not really know what they are. Understandable. They're very technical, but hence the reason people like me and our group would be here to help you. Guaranteed retirement benefit. So typically you put away money now to equal money down the road. So you're just kind of doing it backwards. You're looking at fixed amount of money that you're going to be able to pull out in retirement. And to do that, you have to kind of re-engineer it to make sure you're able to put away X amount of money today to equal that pile of money down the road. To do that, you need an actuary, really smart guy, smart girl, really, really, really smart, understands, when you're going to die, basically, rate of return of your portfolio. It's a very technical job. That is what we do. The employer, the company puts away the money, not the individual, like in a 401k as an example, but the company puts money away. And by the way, usually it's a huge amount. It's a much bigger amount than would be found in a 401k, whatever, 20,000, 25,000 in a 401k, you can put away a lot. The company puts away a lot for the employees. Usually the way we operate, most of our clients are, entrepreneurs, solopreneurs. They don't have to put away money for the employees. They just put away money for themselves. So sometimes they call them solo DB plans or anything of the sort, or mini DB plans or whatever the case is. Anyway, I guess what I'm saying is it's the company that puts money away for the employees, for the participant. In this case, if you have no other employees, you get to put away a lion's share or a lot of money for you, the business owner. Now, what do you have to do that? As I mentioned, you have to have an actuary, really smart person. Well, a bunch of calculations have to occur. Administratively, it's more expensive as a result because you have to have an actuarial team, a little bit of consulting as well. But it's usually worth it because you can put away a heck of a lot more for savings, number one. Number two, you get tax deferral, so it more than makes up for the added cost benefit. Investment risk, defined benefit plans, you have an investment risk. The company that you've put together through what's called the plan sponsor sister company relationship, meaning the qualified plan, the defined benefit plan that's put together as a trust. So I call it a sister relationship. The rate of return, let's say it doesn't go as expected. And let's say you put away $100,000 and instead it's worth, in 5 years, it's supposed to be worth, I'm making this up, $200,000 and it's only worth $150,000. You've been bearing that risk of that investment portfolio not going up as well as you thought. And if you have no employees, it's not as big of a deal. But if you have employees, you might even have to put in money for the employees to true up, if you will, to a certain extent, the portfolio to equal the amount in retirement that should have been had. But now, again, if there's no other employees, it's not as big of a concern. And when I say employees, I really should mean and say participants. Let's go over some key characteristics of defined benefit plan. As I mentioned, employer sponsored. So the company puts together a plan, a qualified plan, that being a defined benefit plan. As I mentioned, guaranteed monthly benefit down the road in retirement. The business owner, if it's no other employees, puts in money, takes money out on an ongoing basis. So you're really shooting for a monthly benefit, a guaranteed amount that's going to be pulled out in retirement. Typically, though, nowadays what happens is, yeah, sure, you might have a money down the portfolio down the road that as a using as a goal, but if there's no employees, usually the money can be rolled over to a qualified plan. Specifically, when I say a qualified plan, by that I mean an IRA. So, and it's just like any other, tax-free or tax-neutral event at that point. Let's say you have a 401k. You're rolling the money over. Let's say you stop working at ABC company. You start an IRA. and you roll the money over to the IRA from your 401k, usually it's the same thing in defined benefit plan. It's a little bit more work. You have to have an actuary, et cetera, but usually it's for the benefit of the business owner because they've been able to put away so much money day one all the way to whatever. In my case, my example, I use day 5. Once again, it's funded by the employer. The company puts money away into the defined benefit plan, just like for a 401k. Instead of the employee deferring money to the 401k, the company puts in money as a contribution to the defined benefit plan. And as I mentioned, we have some cases where people have put away $200,000-$300,000, whereas, if you have a 401k, you can only put in a small amount, fraction of that. Let's talk about the administration of a defined benefit plan. A lot of people are having questions about that because they don't understand it. They haven't been explained. It hasn't been explained to them very well. Let's go over that. So you have to have the compliance element of knowing how much to put in on an annual basis. Usually it's annual basis. So you have to adhere to certain rules, administrative rules, regulatory rules, et cetera. So that's what I mean by ensuring compliance. You got to make sure that you're keeping in compliance. Because if you're not, it can be pretty costly. You got to make sure it's your plan's in compliance. And by the way, what I should say again, if you have any questions, go ahead and email us at info@vastsolutionsgroup.com, info@vastsolutionsgroup.com. We're here to help you as far as defined benefit plans, some of the specifics relating to them. They can be very technical, but usually, if they're well put together, they can save an employer a heck of a lot of money, make a lot of money in some cases because they're able to put away so much more on a tax-deferred basis. Managing investments, portfolios going to be managed in such a way that it is aligned with the compliance element and also all the actuarials. Makes a huge benefit if the situation is being managed as one would expect in a defined benefit plan. Now you got to make sure that let's say usually your actuary, as an example, if it's us, let's say we are working with a CPA tax provider to make sure you're optimizing the portfolio, number one. Then also number two, the contribution amount, because that can help you. Because we have some cases where, clients have been able to get themselves in a lower tax bracket because of the contribution they're making, number one. Number two, because they were able to put away a pretty large, significant amount, thereby, let's just say $100,000. Let's say it's saving someone, $35,000. Well, that's a good tax savings. $35,000 plus being put into a lower tax bracket can save someone a lot of money. That's the reason I said, providing accurate benefit calculations. Now, this is for the administration. This is just so if you're new to defined benefit plans, you understand there is some administration. Or if you have a defined benefit plan, you are really understanding that you do have some administrative capabilities. By the way, the government, our lovely government, is putting more work on our shoulders as defined benefit plan sponsors and consultants. So what I would say is talk to your consultant if you do have a defined benefit plan. Annual reporting, yep, there's more reporting than there used to be. A little bit more work is being required now. You have 5,500. Even if one is not required for your specific plan, you do have an IRS form. It seems like, it's an IRS form, one form. You have to have an actuary, a coded actuary, to be able to sign for you. Also, actuarial evaluation. That's really where the work is. You don't even see, as the plan sponsor, you don't see all the work. Usually it's proprietary. You do that's the reason that I mentioned that, you have to have regulatory compliance, but really ultimately what they're doing is on an annual basis, if done correctly, on a quarterly basis, really figuring out where the portfolio is as far as the rate of return in line with the participants' birth dates, et cetera, et cetera. Funding and investment strategies, you have usually it's a long-term liability management process. Usually it's more than 5 years, and they have to match the liabilities, how much someone's putting away or should be putting away today, to equal how much money is going to be paid out. It's called asset liability matching. It's a little bit more work now is being required of consultants. As an example, a diversified portfolio, it's got to be a little bit more diversified of portfolio than it used to be, which, yes, believe me, that is an issue to some of our clients. Some of our clients are investing in real estate and they're not diversified. So, that's going to be an ongoing project for us, as a matter of fact. Actuarial assumptions. So sometimes those are changing, and you got to make sure that those are in line with ultimate with the liability, asset liability matching. And as I mentioned, I want to make a big point of this. Contribution strategies. You got to make sure on an ongoing basis that your contribution is in line with your current goals. Your cash flow is the most important thing, really. And then also your retirement goals, and then also your tax goals. meaning tax mitigation goals. Contribution strategies are now more important than ever, especially with all the work the government's giving us as far as putting together these plans. Oh, wow, just noticed some of the arrows are kind of looking a little unique here as far as the presentation. I'm not sure what's going on, but participant communication, now more than ever, we as consultants, you as plan sponsor, have got to be able to relay information to the participants. If you don't have any employees, a little bit less work, but it's something to think about. Now, for the people who are thinking about doing defined benefit plans, reasons to do them, you get to, you grow your assets a lot quicker because you get to lower your tax liability by putting money in. Plus, it's a bigger amount. You don't have to pay taxes every year on an annual basis when you pull the money out. Typically, that's when you pay for the taxes. Tax deduction, you could put away a ton of money. The older you are, usually the more you can put away. The longer you've worked for the company, the more you can put away. So there's a lot. I mean, as I mentioned, $300,000 you can put away in some cases. So meaning it's something to think about. If you're, trying to catch up with to retirement, you can put away a lot of money. Market resilience, really the reason I put that in there is because, there's risk. There's a little bit less risk because usually these portfolios are a little bit more conservative. The way I look at it, usually when we're talking to our client, though each client is very unique and customized as such, we make sure that usually the portfolio has to be a little bit more conservative. So over an overall asset allocation, this is the more conservative portion of your asset allocation. What I mean by asset allocation is the distribution of your investments into stocks, bonds, mutual funds, et cetera, et cetera, et cetera. So usually this is the more conservative portion of a portfolio. You've heard of a 60-40 mix. This might be your 40% mix as an example into the fixed income portion of the portfolio. Even really, if you really need to think about it, there's a subsection of that. Instead of 40% going into fixed income, maybe this can act as whatever, depending on the circumstance, maybe 20% of that 40% as an example. Okay, key considerations for plan sponsors. This is for people who are, brand new into the plan sponsor world, or people who've been in it for a long time, or people who are thinking about getting into it. Plan design optimization. Every 3 years, really, more so now than ever, you should be looking at the plan design to see if it's in line with goals when you put together the plan, or down the road, or when you're brand new putting a plan such as a defined benefit plan together. Funding strategies, really got to really pay attention to that more now because there's some new rules coming out. You have to make sure that the funding strategies are in line with the goals. And obviously everything really is determined by the cash flow, which reminds me, I'm going to mention one thing that's very important. Some people say, and rightfully so, some people say, well, wait a minute, aren't defined benefit plans a little bit more captivating, meaning not quite as flexible? And the answer to that, generally speaking, is yes. So that is a consideration, number one. Number two, investment management oversight. It takes a little bit more work as far as the investment management because the assets have got to be tied into the asset liability modeling, and there's a lot more regulatory compliance that's required of qualified plans and specifically defined benefit plans. Now I want to kind of get into when we're taking over plans, kind of what we're seeing as far as some of the issues with defined benefit plans, as far as the administration. This for new people getting into the world of being a plan sponsor, and also people who've been plan sponsors for some time. We'd say regulatory compliance. Usually, the plans we take over are in compliance, but sometimes there might be an 8% deviance of people who are not, or companies who are not running their ship correctly as far as regulatory compliance. Contribution management, this is important. You got to make sure you're in line with contribution goals as far as the plan. And if you're not, that's going to be an issue. We're going to make an estimate that maybe 85% of our takeover plans have been taking care of that regulatory issue. Participant communication, that's the biggest fall down. A lot of people aren't taking care of their participant communication. It's important. If they're employees, it's a bigger issue than obviously if there are no employees. You need to make sure that you're communicating to the participant. And that's an issue to a certain extent that falls on the consultant, but it's worth you realizing as a plan administrator. Investment management, you got to monitor the assets. You have to have usually an investment policy statement, and a lot of people don't have one of those. Hence the reason we're saying about 90% of the plan do, of the plans we take are due, but still there's a fall down, and that could be an issue in an audit. And then finally, the benefit calculations. A lot of people need to revise that because they're old as of old laws. So we're saying some of the people in the plans are not taking care of that issue. Now, once again, this is Mastering Defined Benefit Plans, a guide for a plan sponsor. Hopefully this has been helpful. If you have any questions, email us at info@vastsolutionsgroup.com. info@vastsolutionsgroup.com. It's been a pleasure chatting with you. Hopefully you found value in this. If you have, please feel free to stop by our website. We're here to help you. We're consultants. We've been around really. This is one of our specialties, defined benefit plans, qualified plans, helping to optimize for the business owner. Once again, Kenneth French, thanks for stopping by.